Hello everyone, this is Neil Borate. I am Deputy Editor at Mint. Today I will be speaking to Anshul Gupta of Wint Wealth on a subject that he and Wint Wealth specialize in, which is bonds and fixed income. Apart from his day job, Anshul does extremely informative threads on Twitter, so do follow him there. We are doing this interview in partnership with Wint Wealth, but they have given us full freedom to question them on any subject. With that, let's get right into it. Welcome, Anshul.
Thanks, Neil. Pleasure having this conversation with you.
Likewise. You've been in operation for roughly 3 years since 2020. Can you tell us a bit about that? Where did you work earlier?
Correct. So I've been in the fixed income space for almost a decade now. Started my fixed income journey with Deutsche Bank, then joined a Indian large NBFC investment bank called as IFMR. There we used to structure these transactions, basically bonds, for institutions, for banks, mutual funds, foreign investors, pension funds, etc. And in fact, it was there only we had this idea, like a lot of these bonds are like great assets, but I as an individual don't have any access, while HNIs and institutions can freely access these bonds via their brokers, agents, etc. And that is where the idea of Wint Wealth was born, that how can we democratize this market? How can we make these bonds, which are giving 9%, 10%, 11% returns, available to even individual investor at a lower ticket size. And that is where the idea of Wint Wealth came into being.
You've been in operation for roughly 3 years since 2020. And can you tell us a bit about your journey since then and some hard numbers on the amount of customers that you have, on the amount of money that has been transacted through your platform?
Like you correctly mentioned, we started in second half of 2020. Our business has scaled up gradually. I mean, bonds as a category, it's a new category. Not many investors are familiar with the category. But over past 2 years, this category has shaped up pretty well. We have had support of regulators as well, who have come up with regulations to regulate this space. And Wint as a online bond platform has also scaled substantially over past 2-3 years. In terms of numbers, we have roughly 3.5 lakh signed up users on the platform, out of which roughly 50,000 have done at least one transaction. So I can say roughly 50,000 investors are there. Cumulatively, we have done roughly 1,000 crore worth of transactions on the platform. Every month, we are adding roughly 10,000 users, registered users on the platform. And now monthly, broadly, we are touching almost 98 to 100 crores a month in volumes.
Now, one big pull of online bond platforms is that the bonds listed on them are high yield and therefore high risk. I'm going to quote from the SEBI paper here. To attract non-institutional investors, matlab retail investors, these platforms may offer high yield securities to whet the investor appetite. There is a concern that such high yield securities may be relatively lower rated and investors might fall prey to mis-selling of such offerings due to lack of appropriate product disclosures, which may not be commensurate with the investor's risk appetite. There is also a possibility of the bond platform's involvement with issuers by way of cross-holding, as in an issuer holds stake in Wint Wealth or Wint Wealth holds a stake in issuer and therefore you have an interest in listing that bond. How do you deal with these two concerns?
Correct. So at Wint, we while we do offer bonds giving, let's say, up to 11% yield, we don't go beyond that because we think the risk becomes very high if one is dealing with bonds giving, let's say, 14%, 15%, 16% kind of yield. All the bonds that we offer at Wint, they have at least an investment grade rating, if not higher.
Could you clarify what investment grade means?
Yeah. So all the bonds, all the listed bonds, they need to be rated by a rating agency. These rating agencies are registered with both RBI and SEBI. And they give something called as credit rating, which is nothing but an opinion as per them how risky or how safe a bond is. Now this opinion is given in the form of rating, which can be, let's say, in different categories. So the safest bond will get a AAA rating. For example, Government of India will get a AAA rating. Then bonds which are slightly more riskier will get AA rating. Then the rating will be single A. Then the rating will be triple B. Then double B, single B, C, and last is the D rating. If a bond has been given D rating, it means the bond is defaulted. So broadly, there are like 8 to 10 categories. Investment grade bonds are those bonds which are in the top 4 categories, which means in the category triple B or higher. So any bond which is like either triple B, single A, double A, triple A, which are the top 4 categories, is called as investment grade bond. At Wint, we only deal with investment grade bonds, which means the rating of the bond will at least be in the triple B category. Having said that, there are bonds in double A, single A category as well. We keep on bringing even triple A rated bonds. But the challenge is like most of the triple A bonds, they are giving yields around, let's say, 7.5 to 7.8%. And for a retail investor, we think it makes more sense to invest in a bank FD, which are giving around 8% in today's market, rather than investing in a AAA bond. Because AAA bond, the yields are slightly lower compared to FD rates which are there in the market. And in addition to that, you're carrying the liquidity risk as well. I mean, FD can be broken at any point of time, while for sale of a bond, the willing buyer may not be available. Hence, we don't think AAA bonds are like a great option for retail investors because FDs are much superior compared to the yields that AAA bonds are giving.
Now, one of the most common ways for investors to get into fixed income has been mutual funds, debt mutual funds. You know, for 100 rupees, you can get access to a portfolio of 40-50 bonds. Your risk is reduced. Of course, there have been defaults there, but among the various options available, it seems to be on the diversified side, a reasonable option. So why not just put money in a mutual fund? Why do I need to put money in direct bonds?
As a structure, I really like mutual fund. But unfortunately in India, most of the fund houses, they have become like so conservative that they're not able to beat even the bank FD returns. I mean, we did this study recently. I think more than 95% of the money is parked with government securities or AAA and like very high rated bonds. The net result is the yields that mutual funds are able to give to the investors net of their commission, net of their expense ratio, is hardly beating even FD returns. So my question will be contrary, like for a conservative investor, bank FD makes much more sense compared to a debt mutual fund. There was this taxation arbitrage which was there, but with that going away, I think it makes much more sense to invest in a bank FD, where pre-tax returns are around 8% to 8.25%, versus investing in a mutual fund wherein the portfolio yields for most of them is sub 8%, and net of expense ratio will be, let's say, even sub 7.5%. And in bank FDs, like you have like a complete government guarantee. There are no mark-to-market gains or losses which are there. The returns are predictable. These are liquid investments. So why invest in a debt mutual fund when which are giving lower pre-tax returns, are volatile in nature? I think bank FDs make much more sense. Up to 5 lakh, their money is guaranteed by Government of India. However, the moment we come to AA category or single A category, there is a delta of 100 to 250 basis point. In these categories, the risks are still on the lower side.
Could you explain what delta is?
Yeah, delta will be like how much incremental yield I am getting vis-a-vis, let's say, a FD.
Right.
So, for example, we listed a AA plus bond on the platform. The tenor was only 8 months. The bond was backed by gold loans, and it was giving a yield of 8.6% to the investors.
Right.
Now, such a bond, if I compare to a bank FD, can appeal to a large segment of investors because the returns are higher, the tenor is low, and the entity is also AA plus rated, and the bond is backed by a pool of gold loans. If we come to A rating category, the yields will be somewhere around 10%, 10 to 10.50, which means a difference of 200 basis point compared to a bank FD.
Sorry, so let me just recap this. It is roughly 7.5% for a AAA bond.
Correct.
8.5 for AA, and 10% for single A.
Correct. And in BBB category, the yields can be like let's say around 11 to 11.25.
Okay.
Beyond that, I think the risk becomes too high for retail investors, and that's why we have so far, and we don't plan to go below investment grade rating.
So when the base fluctuates, that's the result of the RBI rate cuts or rate hikes.
Correct.
Now we just discussed the spreads, 7.5, 8.5, and 10. but I wonder if the spreads are enough to compensate me for the risk I'm taking. So I'll give you an example. Recently, HDFC Limited issued bonds at almost an 8% yield. That's a blue chip issuer. Do I need to take on an unknown name and get maybe 9% or even 11%?
Yes, I think HDFC Bank did issue a 7.9 to 8% bond, I think 3-4 months back. Today, if HDFC issues the bond, maybe the same bond will be at 7.5 or 7.6 because, like we discussed, rates have come down by 40 basis point. But I think the larger point you're making is should we be investing in bonds issued by unknown companies for that 150 basis point or 300 basis point difference which is there? I think investment should be seen on the merit, and the merit in this case would be the credit quality of the company which is issuing the bond. And I don't think brand is directly correlated with the quality of the company. In Finance Week have this term called as halo effect. Halo effect means that many times people confuse a good brand with a good investment. This bias is seen a lot in equity markets. We think, okay, this company has a good brand, I've been using the product since ages, so it will be a good stock as well. But we know that's not the case. The stock investment should be seen compared to the intrinsic value of the stock, whether the stock is higher or lower. So a good brand doesn't always translate to a good investment. Hence, if you're looking at the bonds issued by different companies, one needs to see the credit quality. There are a lot of great companies which are AAA rated, AA rated, but no one knows them because they may not be present in retail space. As a retail investor, we would be perceiving a company as a good brand if the company is visible to me. But let's say there is a AAA rated company which is dealing in B2B space, which has businesses as its customers. I may not be aware even of the existing of such a company, but that doesn't mean the company is bad. So that's why it's important to judge the investment basis the credit quality of the company and not by whether the company is a known brand or not.
So let me play devil's advocate here. There have been instances in the past when AAA rated issuers like ILFS, like DHFL have defaulted.
Correct.
So if I can't rely on the rating, then I have to have some brand comfort?
Need not be, because DHFL was a fairly well-known brand and that ended up defaulting. I think most of us would have heard of Diwan Housing. We would have seen the branches of Diwan Housing. So it's a classic case wherein a known brand ended up defaulting. Yes, you should not be only relying on the rating as well. You need to do your own due diligence assessment. Take a look at the financials, the quality of the company, etc. If we are investing in a stock, we don't go by tips only, right? We do our own diligence. What's our opinion on the company? How the company has been performing historically? What's the stock price, etc. Similarly, rating is just opinion given by someone else. One needs to do their own due diligence and only then do the investment.
For a retail investor to do this screening is quite difficult. Even for them to understand, basic financial statements, many people might not have the capability.
Having said that, I think analyzing a bond is much more easier compared to analyzing the equity or let's say trading in futures and options, etc. If I were to analyze the stock of a company, I need to take a call how the company will do over, let's say, 10 years, 15 years, 20 years. What will be the yearly profits, how the risk-free rate will move, and then discount the present value to arrive at the value of the stock. Compared to that, if you were to invest in a 2-year bond of a company, the only call you need to take is कि company 2 साल survive करेगी नहीं करेगी.
Right.
It doesn't matter what the profits of the company are, how the stock price is moving. If company has survived for 2 years, you will get your coupon back.
Correct. Coupon meaning interest.
The interest and the returns back. So bond investment is as simple as that. You need to take a call. If bond का tenor 2 साल है, company 2 साल survive करेगी नहीं करेगी.
As a lazy investor, I would much prefer it if somebody else does that job. As a platform, what are you doing to ensure that you don't have companies which will default?
Wint Wealth is not a open marketplace. I'll say it's a curated platform which means it's not like any and every bond can be listed on the Wint Wealth platform. Firstly, I think it's important for investors to understand there are different kinds of bonds as well. The safest are senior secured bonds. The ones which are slightly more riskier are senior unsecured bonds. Then there is something known as subordinate bonds or perpetual bonds, which are like very, very risky. And personally, we don't think are meant for retail investors.
So just to understand, the last category is the same as 81, and there was
Correct.
a very high-profile default.
Correct. These are the same bonds where there have been multiple cases of default in India and abroad. And in India, a lot of senior citizens lost their hard-earned money.
In 81s of Yes Bank, that's a very well-known public.
Correct. So one criteria which we have done is we only bring senior secured bonds on the platform. We don't bring unsecured bonds, subordinate bonds, perpetual bonds, etc. Secondly, the issuer, the company who is issuing the bond, is thoroughly vetted by our team. We do a diligence on the promoters of the company, the equity investors backing the company, the financial health of the company, the systems, operations, processes of the company, reference checks in the market, and only those bonds which we think we would be comfortable personally investing in are brought on the platform. And third, and a very important thing which we have done is we try to bring amortizing bonds. It's a slightly technical term. I'll explain how an amortizing bond is different from a regular bond. I think more than 2/3 of the bond market in India consists of something called as bullet bonds. Bullet bond is where the principal is returned in one shot at the end of the investment, which means, let's say there is a 3-year bond, a bullet bond. You invest 100 rupees in the company will return you back the principal at the end of 3 years in one shot. That's majority of the market. At Wint, what we bring are something called as amortizing bonds, where your principal is repaid back to you in tranches, which means if this is this 3-year is a yearly amortizing bond, this 100 rupees will be returned back to you in 3 tranches of 33 rupees each. This significantly reduces your risk over time. In case of bullet bond, if the company were to default, let's say at the end of 2 years, the entire money is stuck in the bankruptcy proceedings. In case of amortizing bond, you would have already received 2/3 of the investment due to this amortizing feature. So this significantly lowers risk for the investors as well.
So essentially, in the amortizing bond case, the company is paying an EMI.
Correct.
And every month, every quarter, you're getting some part of your principal back.
Correct. Along with the interest.
Right. So what are the kind of issuers that come up on Wint Wealth?
These are mostly NBFCs, non-banking finance companies. Can be in BBB category, can be in single A category, can be in AA category. Most of these companies will be backed by marquee equity investors, private equity investors, which have deep pockets, etc. Most of these firms will have a balance sheet in the range of 1,000 crores to 10,000 crores. So I would say mid-sized companies. Most of these will have at least, let's say, 10 to 15 existing lenders, mostly banks, mutual funds, etc. So it's a good validation that the company has been able to pass the diligence filters of these other lenders as well. Liability of these companies is like fairly diversified. It's not like this company is borrowing only from Wint Wealth investors. This company has borrowed from banks, NBFCs, mutual funds, foreign investors, etc. Most of the companies will have like a fairly granular retail portfolios, can be in vehicle finance, SME finance, housing finance, personal loans, etc. So this is like the typical parameters of the entities which come on Wint Wealth.
So the bonds that they issue, are they what is called asset backed, as in are they backed by pools of property loans, car loans, etc., or are they just backed by the balance sheet of the NBFC?
They are so these are like senior secured bonds, which means they are issued by the company. So company is fully obligated. The company is giving full guarantee to repay back the money to the investors. To further protect the investors, these bonds are secured, hence the word senior secured, by a pool of receivables. This pool of receivables is something called as collateral. So let's say there is a NBFC which is giving gold loans to its end borrowers. A portion of those gold loans is earmarked for this bond. and given a security that tomorrow if the NBFC were to default, were to go bankrupt, the money coming from these gold loans can be used to repay back the investors. This recovery will be subject to bankruptcy proceedings, etc. So might take some time, but still this is the second level of protection which is available to the investors. So company is fully obligated. In addition, this pool of loans is given as a security.
Now, one point you made is that a lot of the issuers on your platform already have funding from banks, and that is a comfort that the bank has done due diligence.
Correct.
But my question is, if they are getting money from the bank, then why come to you? Why issue bonds?
Correct. So 2-3 motivations are there. One is like if you speak with CFO of any entity, one key risk which is there while managing the liabilities of NBFCs is the concentration risk. If a NBFC is completely dependent on mutual funds, for example, we know post the ILFS scenario, a lot of mutual funds just pulled back from the lending. They become like very conservative. Most of the money was going in GSEC, etc. So imagine what will happen to such a NBFC which was completely dependent on mutual funds, and that investor pulled back. Not a single investor, the entire category pulled back. Same thing can play out with banks. Same thing can play out with foreign investors. So a good CFO always tries to diversify the sources of capital for the company.
Right.
They'll want some capital to come from foreign investors, some to come from mutual funds, some to come from banks, and obviously some to come from retail investors as well.
Sorry, even if that means that they are not getting all the money from the cheapest source,
Correct.
even if it means that the weighted average of all these sources is slightly higher than the cheapest source.
Correct. In fact, in terms of like funding cost, banks in India are typically the cheapest. So if one were to optimizing for only the cost of funding, entire funding companies will take from banks. Mutual funds come at a premium, foreign investors come at a premium, and retail investors also come at a premium. But because companies want to diversify, they need to cater to, they need to like appeal to all the pools of capital, even if it means paying, let's say, 50 basis point or 100 basis point extra for getting that access to diversification.
How many bonds, when I say how many, I mean what number of issuers have come onto Wint Wealth so far since launch? How many of them have defaulted?
We have close to 20 plus entities on the platform. There hasn't been even a single default on any of the entities or any of the bond.
In the past 3 years?
Correct.
Is there outstanding debt that has been issued in the past which has not matured where there could be default?
Unlikely. I mean, roughly 10 bonds have like fully matured till date. Like I said, most of the bonds are amortizing in nature, so the companies are repaying back their EMIs on time. There hasn't been even a single day delay for get default in any of the bonds which are live. And on the contrary, a lot of our entities, I think 1/3 of our entities have been upgraded by rating agencies during the past 3 years. So we are not seeing like any issues, any delay, any stress on any of the portfolio entities that are there in the on the platform.
Anshul, can you tell us a bit about the age and income profile of the users of your platform?
So typical investors on our platform, they are mostly in their 30s. Maximum age profile would be typically around, let's say, 45 to 50. So bulk of the investors will be in this age bracket. Most of the investors are coming from tier 1 and tier 2 cities, mostly salaried people. And these are people who are in the 30% tax bracket, but are not like ultra HNIs or HNIs yet. So these are like investors who like to explore new products, are somewhat financially savvy. So this is a typical investor persona on the platform.
Now, you have the prestige of Zerodha backing. Tell us about your journey as a startup. Given that we now seem to be in a funding winter, your customers would want to be reassured that you can continue as a business for a long period. Are you profitable?
So like you said, we are lucky to get backing of Zerodha, who via their Rain Matter fund came on as our investor in our seed round. Subsequently, Wint Wealth has raised equity money from Fidelity arm as well, their Indian arm, which is called as Atod Ventures. Per se, as a business model, we don't need like too much capital because it's just a platform. We are only providing a service, and at no point of time there is like any of the repayments which is flowing via Wint Wealth. So for all the transactions which are happening on the platform, there is a SEBI registered debenture trustee, which takes care of all the regulatory aspect, compliance, repayments, etc. So per se, money doesn't flow via Wint Wealth. So there is no counterparty risk that the investors are taking with respect to Wint Wealth. Having said that, I mean, due to our significant equity raise in our Series A round and seed round, we have like enough capital in the bank to have a runway of, let's say, more than 5 years. We are not yet profitable. There is like almost break even is there. The Indian bond market is still developing. Even though these bonds are listed on the exchange, the trading is relatively on the lower side. We in turn can reach out to the other users on the platform.
Now, before SEBI came up with these regulations, it had put out a consultation paper. In that, it had identified some concerns with online bond platforms. I'll list them out. So, for example, there was no standard KYC. There was both listed and unlisted debt that was being offered by such platforms. There was no formal mechanism for investor grievances. There was misrepresentation, mis-selling, and lack of regulation.
Correct.
So, how have each of these issues been addressed?
Correct. I mean, like some of these points we also noticed, like as the category was expanding, we noticed like a lot of French players were coming into this ecosystem, and they were not like following the best practices like which should be followed. For example, a lot of unrated bonds were being sold to retail investors. Bonds issued by stressed entities giving 18-20% yields were getting sold. Proper disclosure information wasn't made available. These investments were being portrayed as alternate to FDs or risk-free investments, which these are not. So what SEBI has done is they have released regulations so that all these points, all these concerns can be set aside. For example, we can now do only listed transactions. If a transaction has to be listed, it has to be rated automatically. So that eliminates anyone downselling unrated instruments to the retail market.
Sorry, let me just understand this point better. So essentially you're saying that if I want to invest in a bond through Wint Wealth after you become a broker,
correct,
it can only be a listed bond.
Correct.
And second, it has to be a rated bond.
Correct. That's
so
correct.
AA, AAA, whatever that
Correct.
rating is.
Correct.
Okay.
Now, bond platforms can only sell listed, which in turn means also rated bonds. They cannot sell unlisted or unrated bonds. And even the norms around KYC, the settlement, all these things have been like, all these concerns have been like clearly put to rest under the new framework.
Now, Wint Wealth itself is not a SEBI registered investment advisor. You don't owe legally any investor any fiduciary responsibility. So how does a customer get redress if something goes wrong?
Correct. We are not a RIA per se, we are not an investment advisor, but we are a SEBI registered intermediary. So if any investor thinks a bond has been missold, there have been like a overpromise made by, let's say, Wint Wealth. So investors can reach out to SEBI, and SEBI will do an investigation, and any mis-selling, any misconduct on part of Wint Wealth will get regulated by SEBI.
Right. But just to be clear, the recourse is against mis-selling. It's not against default. If it's default, then the risk is of the customer.
Yeah, even in case of like investment advisor, the advisor can only guide you, advise you. Ultimately, the risk is being taken by the investor. Similarly, like Wint Wealth will do proper disclosures, will educate the investor. But yes, ultimately risk remains with the investors. These are not risk-free investments. These are not alternate to FDs. Investors should not park their emergency funds here. They should take only that much exposure, which they understand and are comfortable with as well. So we tell our investors, start small. It's a new asset class. It's a new category. Only once you completely become comfortable with the asset class, then only like increase the allocation in the portfolio. But ultimately the risks and the returns lie with the investors only.
How about other collective vehicles like portfolio management service, PMS, or alternative investment fund, AIF?
No, they are good. I think the challenge there is with respect to the ticket size, which is 1 CR.
For AIFs.
For AIFs. And for PMS it's like 50 lakhs. But otherwise, like if the fund manager is good, I think it's a good vehicle to take exposure via.
Right. So currently on Wint Wealth, it's not possible to buy a portfolio of bonds. I have to individually pick each bond.
Correct.
Now let's talk about process. If you can tell me step by step about how I can buy a bond on Wint Wealth.
It's a fairly easy process. You need to have a demat account, which I think most of us have now in India. Just log on to the website, which is wintwealth.com. See the bouquet of bonds which are there. Ensure you understand the risks and returns in each of them. If there is any query, you can reach out to our team via WhatsApp, phone call, etc. Once you have done the selection, you can choose how many units of bond you want to invest. Complete your KYC, enter your demat account, make the payment, and the bond units will come in your demat account. It's as simple as doing shopping on Amazon once the KYC is done. So the process is very smooth, very seamless, and that's it.
Okay, finally, let's turn to your personal portfolio. Do you directly buy bonds, and if so, which ones?
Yeah, roughly I think 15% of my portfolio, maybe up to 20 as well, is in debt. Within that, 80 to 90% is directly in bonds, which I have bought via Wint Wealth only.
That's 80 to 90, 80 to 90. Most of it is in direct bonds.
Yes, right. Most of my debt portfolio is in direct bonds. Right. My debt portfolio is roughly in the range of 15 to 20%. These are non-SGB bonds. SGB bonds will be additional roughly 10%.
SGB meaning sovereign gold bonds.
Sovereign gold bonds, which again have been bought via Wint only.
Right. And in terms of issuers, can you tell us some details? What credit rating or?
Most of the issuers that we have brought on the platform, I have invested in most of the bonds. The rating have been from A category to BBB category. Yields have been between 9 to 11.5%. I think I would have invested in around 15 to 20 bonds.
So you've roughly got 9 to 11% return from them?
Yeah.
Fantastic. Anshul, thank you so much. It was lovely speaking to you.
Pleasure.